What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. I'm joined by Stephen Gregory, Head of Quantitative Research at Piper Sandler.
Hello, Michael. How are you doing today?
I'm good, Stephen. Happy Memorial Day weekend.
Yes, happy Memorial Day to you. We have an exciting week coming up. We have NVIDIA earnings, and that's wrapping up this earnings season. And it's been an interesting one, maybe not so much from the earnings picture, but the overall market has been quite exciting recently. Multiples have rallied a lot.
With respect to valuation, there's really three things that matter. And usually there's two things that matter. It's changes in interest rates and inflation and the views there, and changes in the macro data, particularly unemployment. Sometimes oil prices are really volatile. They spike or they collapse, and that causes market volatility in the valuations. This year, and maybe for the next 3.5 years, it's policy volatility. And in the last few years, it was the Fed policy that was driving valuation volatility. This year, it's certainly more the Trump administration. And even in the last week, we've gone back and forth between focus on interest rates and the deficit and how that's going to impact things going forward. And then Trump raised tariffs, or announced that he's going to raise tariffs on the EU by 50%. And then that didn't last very long. Over the weekend, Trump has already paused those for a few weeks. So perhaps the market goes back to focusing on the budget deficit as the bill gets pushed to the Senate. But yeah, there's been a lot of volatility here. And so valuations, when you look at the market, they should be elevated for a whole host of reasons. Energy prices are very low. Typically, when you have a backdrop in the US of lower energy prices, multiples are higher and vice versa. And when you look at the composition of the S&P 500 today, of course, the fundamentals today are far superior to any 5, 10-year, 20-year average, also suggesting we should have higher multiples, whether it's interest coverage ratios that are near all-time highs, margins very high, and of course, your typical cyclical sectors that are typically lower PE are much smaller today. And those would be financials, industrials, energy, and materials. So that also plays a role in the composition of the market, plays a role in the valuation. So at the end of the day, the multiple is back to 21 and change. Earnings estimates for the S&P over the next 12 months are expected to be about $278. And so here's a fun fact. The next year's 2026 earnings estimates basically about $300 right now. And so all else being equal, if those earnings estimates hold and the PE of the market ends the year where we are today, a lot of assumptions and unlikely to happen, but what is priced into equities is that the market will go up by 8% from today through the end of the year. And that's the earnings number on a forward basis, basically getting to the 2026 number at the beginning of next year, back to $300. So the math on that is, again, the current forward earnings estimate of the market looking out 12 months is 278. Time goes by, we end the year, and if the earnings estimate sticks at 300, the new earnings estimate on a 12-month forward basis will be that exact number. That's 8% higher than we are today. You multiply that times 21, and you get a 8% increase from where we are in the market. So that's just, again, to get a sense of what is priced in. Of course, the multiple could go down or the multiple could go up. Certainly, there's a lot of uncertainty in the market today. You could argue is even depressing multiples even at these high levels, or at least has the potential to push multiples up higher if fears around inflation policy and economic growth continue to get priced out. And that's pretty much where we ended last year after the election. Markets had priced out recession risk, inflation risk, and interest rate risk, which is what basically brought you to the highest levels in PEs since COVID and the lowest levels in credit spreads since, I want to say about 20, 25 years. So we're a little lower than that today. There is some uncertainty. Whether it's fair or not is really going to be a function of how the data unfolds and how policy headlines unfold.
So, with a lot of the pressure coming off the kind of trade war policy uncertainty, bringing multiples back up, that puts us back in the multiples are high, credit spreads are low. You're going to be relatively range bound on multiples with a bit of the swing factor around rates. That's definitely a concern with the budget, and expecting about 8%. Basically, you believe multiples are going to be relatively range bound pending some sort of event, which puts the spotlight back on earnings. That's really the only possible swing factor in the market return equation.
Absolutely. And there's going to be probably a pretty long tail to the uncertainty with respect to earnings because there's so much policy change taking place even beyond tariffs. There's consumers that are now having to pay back their student loans. There's changes to the FHA forgiveness programs where some people did not have to pay their mortgages. We've got new tax policy. That's some of it's going to be retroactive. So there's a lot of moving parts. And we think the economy is going to continue to remain, at least in the aggregate, appear fine. I don't want to say strong or weak, but underneath the surface, we also think things are going to remain bifurcated. With all of the volatility and uncertainty to date, we've started to see large cap earnings begin to stabilize, and they're probably still a bit too high as they typically are, and will probably come down a little bit. At the same time, we've seen mid and small cap earnings, particularly small cap earnings, continue to accelerate to the downside. And I think that's really a function of when you look in small caps, there are much more current economic issues like high interest rates, concerns around how much lending we're going to see from banks, real estate issues, smaller cap consumer and technology names, which tend to be more speculative, tend to be more leveraged. So there's really, we still have this tale of two markets when you look at the fundamentals and arguably with respect to what is strong, what is weak. So if the multiple has more or less fully recovered from where it was at the beginning of the year, you're exactly right. From here, it's earnings. So looking at the earnings backdrop and looking at the issues around that, to us, it seems that you're going to continue to see this larger company earnings outperformance as we've remained generally a status quo economy over the last couple of years. High interest rates, high price levels, an employment backdrop that's okay. So positioning in many ways hasn't really changed a whole lot, at least taking out the end of March into early April and the recovery in the market. So we're kind of hopefully not going to see much more broad-based tariff uncertainty in the market. And with that, we're likely to see correlations within stocks continue to come down, macro volatility driving the market continue to come down, and it's going to be more of a stock pickers market focused on earnings. At least that's the hope, and that would be good news for active managers.
Yeah, so with multiples back, that earnings bifurcation story really picks up again. Probably going to start hearing more about the Mag 7 again. They haven't had the greatest year, but when you look underneath the surface, one of the things I've heard you say many times is that mega cap trade isn't just the Mag 7. These large mature companies that are continuing to perform on an earnings basis, have strong fundamentals, great interest coverage, strong balance sheets. One of the things that caught me so far this year, that blended number of some earnings reports and estimates for the rest of the calendar year, we have S&P 500 2025 growth coming in at 9% so far, and the equal weighted coming in at 4.8. So the S&P 500 space in aggregate is growing, but the best growth is in the larger cap names that make up that cap weighted portion.
Yeah, it's still about double, or actually a little more compared to last year. S&P earnings grew about 10.4%. The equal weighted grew about 5. So again, kind of a 2-to-1 ratio. What's interesting is in 2026, and this is for all intents and purposes eons away at this point, but the growth rate for S&P 500 and the equal weight are expected to be exactly the same at 13.2%.
So you'd have to expect one of those numbers to come down.
Yeah. And just looking at the sector expected earnings growth, it's positive earnings growth across all 11 sectors. In, I would say, most sectors, excluding staples, real estate, and utilities, and comm services, the street is looking for double-digit earnings growth. So those types of expectations are more synonymous with a broad earnings rebound. And it's possible, but as we've been pointing out, we have a very bifurcated economy. And in order to get a broad acceleration in earnings, you likely need interest rates to come down. So I'm not sure if that's literally embedded in those earnings. I doubt it is, but we had a similar setup at the beginning of this year, seeing analysts were expecting a broad-based earnings increase, and that has radically changed already now 5-6 months into the year. So we'll see, but that's no surprise though. Same thing in 2027. I think every year, as long as we avoid a recession, the out years are going to be forecasting a broader recovery in the earnings backdrop, because there's just been such a long bifurcation beginning in 2022.
Given the news narrative of the day, it's hard to see, or at least to foreshadow rates coming down a lot right now. That's probably not where the market is, at least today.
Yeah, I think we're kind of stuck at these levels, give or take 40, 50 basis points, in a sense that we're a bit between a rock and a hard place, I think. Assuming we can avoid a recession, and there's really two ways to get interest rates down. There's a recession, which is higher unemployment. And the bigger the unemployment spike, the more likely you're going to get rates down because you get the Fed to cut aggressively. But that's an aggressive rise in the unemployment. It's not our view. The other way, of course, is inflation. And we've already have inflation down. Most of the popular inflation metrics are around 2%, a little higher, 2 to 3%. So the low-hanging fruit, certainly from COVID, from 9% in late 2022, has been picked. So at this point, in this economic backdrop, remember, this is not pre-COVID, post-GFC world where inflation was always under the Fed's target and very low, and they couldn't get inflation to move much higher. We seem to be in a bit of a different backdrop now, and everything that's going on globally, or much of what's going on globally, perhaps besides lower oil prices, has been keeping those inflation rates sticky. So in a sense, you can get rates down a little bit, but inflation's probably not going to do a whole lot in terms of getting long rates down or getting the Fed to cut aggressively. And if we go into recession, of course, that's not a good way to get interest rates down. And the outcome could become quite precarious for the economy or for the market. So yeah, we think we're going to see rates continuing to bounce around. Here's a fun fact. We've had 8 different narratives around interest rates since 2023, where the market was more or less convinced we were either heading to recession, heading for a soft landing, or heading for a period of higher rates for longer. So we bounce around those 3 narratives now 8 times. And we'll probably see a 9th time and a 10th time and an 11th time before we either break out and sustainably move to higher levels of interest rates, which I think is going to be really hard to do because of how rate sensitive and financialized our economy is, or break down and see much lower rates, which is likely a result of a recession, which I also think is going to be more challenging to see, because I think there's a lot of reflexivity in our economy. And I think part of the reasons you've seen rates, every time they got down to 3.5, 3.7, 3.8 on the 10-year, they bounced up pretty sharply, because every time you get down there, you get people to come into the housing market, and you see a rebound in housing, you see a rebound in sentiment, in business optimism. So after each of these drops in rates, you've gotten a bounce in a lot of economic and sentiment data, which pushes rates back up, and around we've gone.
8 narrative shifts in rates. That's just pretty wild. So any call on rates, you've been both right and wrong, depending on the month.
I mean, just eyeballing the chart, the 10 years probably averaged around 4.4% over the last 2.5 years. So we're more or less there right now. But yeah, you've had a pivot in the narrative every 4 or 5 months.
Pretty incredible. It's been an interesting time to be in markets. You've talked a lot about earnings. It's definitely been something I've been super focused on. You've just seen so much uncertainty and people trying to figure out what the impact's going to be. One of the charts that we always like to look at is those earnings revisions, which is the percent of companies within the S&P 500. So what percentage of 500 companies are seeing their forward estimates go up versus the broader universe? And that had dropped down to 20 there last month and then shot right back up to the long-term average. So it's been a pretty interesting time in markets. And that's kind of just your idea that this constant narrative shifts. But it's nice to see that from a multiple standpoint and earnings standpoint, we are back to a more normal backdrop, which puts us back to some of our past podcast episodes, talking about how credit spreads are low and a lot of things are priced to perfection.
Yeah, I think in terms of the upside for the market here, I think makes a whole heck of a lot more sense just to think about it generally as opposed to trying to think about it mathematically. In other words, of course, if those earnings estimates stick and the multiples stick, the market will be up 8% through the end of the year. But we can think about, well, what could drive multiples higher or lower? And again, I think if inflation fear continues to mitigate or be mitigated, certainly that will be impacted by what happens in the White House. And as long as the employment data continue to remain okay, we should probably see valuation levels stay at these ranges. But it's hard to see the market make material upside from here without one of those two outcomes moving towards a better backdrop.
Investors have been spoiled over the last couple of years with double-digit returns, but if we can pull up 8% this year, you mentioned that 13% for next year, obviously that's going to come down, but those are good outcomes from a return standpoint.
Yeah, absolutely. But you're right. Investors have been spoiled with periods in 23 and 24 after a big downturn in 22 of multiple expansion 2 years in a row on top of a very strong earnings backdrop led by AI. And the average return in the market over the long term is somewhere around 8-9%. So it's certainly been far superior. And I remember at the beginning of the year, we were doing our outlook, we talked about returns that were going to be far lower than what we've seen in recent years and how that was going to likely frustrate investors. Because think about it, in 2020, 2021, 2023, and 2024, you had huge upside returns in those years. And I think investors have, in a sense, gotten maybe a little bit too used to markets being up or down 20%, because that's been the case for several years in a row now.
8% is probably, as you mentioned, right about average for the last couple of years. But one of the things I've seen you do before, which I think is always so cool, your measurement period matters. What is the long-term multiple? Well, do you start measuring it 10 years ago? Do you start measuring it 20 years ago? Do you start measuring it 50 years ago? And one of the interesting things that I'd seen somebody put up, if you take the S&P and you look over the modern history, it is about 8, 9, 10%. But if you go back 70 years, the average return is about 6.6%. So your measurement period matters. And that's the recency bias that you're talking about the last couple of years, 20%, 20%, and 20% down. We've just gotten kind of used to these big swings. Wow, if we can put up 8% 2 years in a row, that's still above that long-term average. The long-term average, I guess.
Yeah. Another stat about the market that you often quote that I think would surprise many people, what percent of trading days, is the S&P 500 up?
I love that one. I remember the first time I saw it, I had to ask other people to check it. Daily returns, up or down, are basically a coin flip. You're up 51 and change % of days. So you wake up tomorrow, it's up. Statistically, the next day, you're likely to be down. Though we do know over the long term because of the compounding, but daily moves in the markets are pretty much a coin flip.
Yeah. Unfortunately, the positive days tend to average bigger up returns than the negative days. So you get that. Ironically, it's called a Webull distribution.
Yes. Very interesting stuff. I think that is definitely a fun fact that would surprise a lot of people. If you get 8, 10, 20% years, you'd think, oh, market's up most days. It's not. This is great, Michael. A really interesting conversation. So to wrap us up, can you give us 3 things that you're keeping an eye on in the couple weeks ahead?
Sure. Yeah. We get a lot of data next week, actually the next 2 weeks. So in terms of the data, we're going to be getting data next week from April, which is durable goods. We're getting some March data from home prices. And the only real-time data will be consumer confidence. So I would say that probably will be the most relevant data point next week. We'll get GDP, which will be probably, I would argue, one of the most irrelevant data points and backward looking. Of course, we're going to have NVIDIA earnings. So that is going to continue to shape a large part of the market and investor expectations. And given the pause, I don't know, did we talk about this? The European pause on tariffs that didn't last that long. The market's, I think, probably going to be again, refocused on the tax bill and interest rates. And we're at a level right now where higher interest rates is likely to cause a ceiling or put a ceiling in parts of the market, those rate sensitive stocks and lower quality stocks with weaker fundamentals. And that's where, if rates start moving up again, you're likely to see multiples compress first, as you typically do. So I'd say those three. And of course, anything coming out of the White House. You never know what to expect these days.
Rates, earnings in Washington. Oh my.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.